Welcome to the Broken Pie Chart Podcast, episode 332. I'm your host, Derek Moore. I'm solo this week. We will have a guest next week. All right. Yep, more new highs. And someone passed me some interesting data. I think this is from Charlie Bolello on Twitter. I kind of recognize how he normally formats his stuff. And it's the time prior high to new high in months. And going back to 1957, this is the shortest time between an old high and a new high when there's been at least a 19% drawdown. So technically 20% is a bear market. I like that he used 19 because this includes December 8 of 18. It includes 98 and 1990. Those were all sort of near technical bear markets, but they were 19 and whatever. So 4.2, that actually eclipsed the 5.8 months it took in the COVID period, February 20 to March 20, when the market was down 34%. And there's some interesting stuff on here. Number one is, it's got a column that says NBER recession. That's National Bureau of Economic Research. And we have no idea because we won't know if we're in a recession. And I'm not saying we are, by the way, but you don't know if you're in a recession until after the fact, because the committee meets and they say we were in a recession and it started here and ended here. But not every one of these ends with a recession. And there's this common thing that says, if you don't have a recession, typically it stops at around 20% down. But we didn't have recessions, let me see, August of 87, October of 87, and it was down 33%. That one took 21 months. But the reason I wanted to bring this up is because Jan 22 to October 22, it was 24 months. It was a decline of 24%. And that was sort of more of a normal bear market. Normal bear markets meaning they started, it was kind of slow and steady down. There were some gyrations in between, but it was sort of a normal bear market, not these V-shaped recoveries like we saw in the COVID period in 2020 and also most recently with the tariff tantrum. And that's a normal one, 24 months prior high to new high. We just did 4.2 months. And it's also the quickest low to new high, 2.6 months. Prior one was September 18th to December 18th, 3.6 months. But the reason I really want to get into this, okay, I said that already. It's just when we look at how long it took from one high to get to a new high, I think a lot of investors, and maybe not the younger investors, but we look at the 07 to March 09, it was a long bear market. It was 17 months. September 2000 to October 2002, 26 months, respectively, peak to trough, minus 55%, minus 47%. And it took 55 months from the end of the bear market in March of 2009 until April of 2012. From the end of the bear market, October 2002, not until October 2006, 75 months it took to make a new high. And so this has been, I don't know, I mean, the average, I guess, bear market length is 9 months. The average months to get a new high from the old high is 23, and the low to the new high is 13 months. That's the average. The median, as they say, is about 16 months from prior high to new high. So what does this mean? I mean, I think it's one thing to point out is that, yeah, it's a lot quicker. But you know what? We did have a long bear market. I mean, it took 24 months, 2 full years, basically, to get from the old high to the new high in the 2022 bear market. So, we've had these. All right. So what does this mean going forward? Well, The other thing that comes up right now is I was talking to somebody recently who's not really that much into the markets, doesn't follow it like all of us do. Assuming you follow it if you're listening, or you just stumbled upon this for one reason or another. And there was some data out. It looks like this is from FactSet. Who is this by? Wealth of Common Sense. So it was titled "Don't Fear All-Time Highs," and it's the S&P 1 year, 3 year, 5 year forward returns investing at all-time highs versus all other days. And the 5 year forward return, let me see when this is from, since 1950, plus 50.2% versus plus 48.5%. And the higher one was investing at when it was at all-time highs. The 3 year, 29.1 to 27.3. Average 1 year forward return, 9.4, 9.1. I'm starting to, not only for people who don't watch the markets, but people who do watch the markets, and they're saying, oh, I don't know, we came all the way back. We're due for a sell-off. I mean, they pulled this data from 1950, and basically it's confirming what I think conceptually I understand about watching markets for a long time. Just because you have a new high doesn't mean that you're going to make a new low, a more recent low. It doesn't mean you're going to have a bear market or a sell-off. Could we have corrections? Absolutely. Who knows what's going to happen? That's one of the reasons why the primary thing that we do is buy and hedge. But I agree with the title of this. You shouldn't necessarily fear an all-time high. I don't have the study with me, but Jay and I ran some data a number of years ago, and you'd be surprised what percentage of the time a market is within 3% or less of an all-time high. It happens all the time. And as I always say, markets never make a new all-time low. They only typically make all-time highs. And to reference the previous discussion that we were just having, sometimes high to high takes 75 months. Sometimes it takes 55 months. Sometimes it's 2 years. Sometimes it's 7 months, 4.2 months. But sometimes new highs beget new highs. And just because you make a new high doesn't necessarily mean the market's going to crash. Doesn't mean it's not going to crash. That's why we hedge. All right, I want to talk a little about something else. And I had some time with the holiday, or of course we're recording this on what am I doing? The Saturday after the holiday. And I keep hearing a lot of stuff, and maybe it goes into the idea that, the dollar has lost 90% of its value since such and such a date. And this is why we need stable coins. This is why we need crypto and Bitcoin. I mean, that's a whole other discussion. But I keep hearing this thing about how the dollar has lost all of its purchasing power. And that is correct with a caveat. First, let me tell you why it's correct. Let's say in, 1960, you had a dollar bill. Great. You're like, this is fantastic. I got this $1 bill. I'm going to jump in a time machine. I'm going to go forward. Wouldn't that be cool? And they get out at the December 31st, 2024. Why 2024? Because I'm using annual data. And basically they get out of the time machine, and somebody there meets them and says, great, I'll take your dollar and I'm going to give you 9 cents. And the person says, why would you give me 9 cents? I have $1. Well, we have to adjust that for inflation. So you basically have 9 cents worth of purchasing power for the dollar that used to be a whole dollar. And the way that you do that is you look at the simple CPI index, consumer price index, you look at the basket of goods, and you do a calculation. So for example, to look at 2024, you're basically taking, the value of you're basically doing like what it cost years ago divided by what it costs now times your dollar. And yeah, I mean, you're down roughly 90% in purchasing power. But that assumes that you have that dollar and you leave it under your mattress and you're getting no return on it. And this is where I have a problem with the old, oh, we need this thing or that thing because the dollar's lost 90% of its purchasing power. Yeah, if you left it under a mattress. But who does that? Who should do that? And so what I did was I went to Professor Oswath Damodaran's from NYU Stern Business School. I used his data and I would have went back further, but I can only pull the CPI. I was doing it quick till back to 1960. So I said, what if you had a dollar and we know the CPI, I basically took $1 and I compounded it at whatever the CPI was. And I said, well, let me see what that dollar basically, what's something that costs $1. What's the inflation adjusted price of that today? And it's actually $10.76. So I'm kind of doing it the other way. I'm saying, imagine there was a candy bar that cost $1. You adjust it for inflation, and today it costs $10.76. And then I went and I looked at, what if I had that dollar and instead of putting it under the mattress and not earning a single cent in compounded interest or compounded return, just took Professor Damodaran's 3-month T-bill annualized return and said, 3-month T-bill, okay, that's the risk-free rate. So now some of you might say, well, how would I buy a 3-month T-bill? And but the point is, like, that's the risk-free rate. That's a 3-month T-bill. That's probably the near money, the near-term interest rate. And so I took that. I said, well, what if we take this dollar and we just compound at the annualized return of the 3-month T-bill? And I will tell you that, like 1981, the annual return in 1981 is 14.04%. CPI went up 10.33%. Year before, CPI went up, inflation went up 13.55%. The return was 11.39%. But I went and I did that, and I said, well, if I compounded my dollar compounds to $11.74. Remember that CPI adjustment, a dollar inflation adjusted goes to 10.76. And so, yeah, if you threw it under the mattress and got nothing, your dollar would depreciate by 90%. You would go from $1 to 9 cents. So don't do that. That's why it's important, even if you have cash. And I was railing against some of the large banks who were advertising, oh, you can get 0.03% on your cash. And whether it's Schwab or whether it's other firms, that there are money market funds, there are something like BIL, for example. I'm not necessarily telling you that's the one you need to buy, but it's a 3-month Treasury ETF from State Street. We use that in some of our portfolios. But that there's vehicles you can put your money in. And some people might say, well, what if I need the cash? Remember, that's the benefit of using liquid securities. Treasuries, if you're buying treasuries directly, if you're buying an ETF or you're buying a money market, and always check this stuff. But it's pretty liquid, meaning if you need the money, you sell it. So I bring this up because I think it's a really bad and it's a lazy argument to say that the dollar has lost 90% since whatever, or the dollar's lost almost 100% since 1920 or whatever. I would have gone back further, but I couldn't grab the CPI data really quickly. And that's the 3-month Treasury bill rate. That is the risk-free rate, which, by the way, everything is sort of anchored off all the returns, all our risk-adjusted returns, all that type of stuff is anchored on the risk-free rate. So then you say, well, what if somebody had that dollar and starting in 1960, they invested in the stock market? Okay, and somebody might say, well, I'm not necessarily going to put my cash in the stock market because I might need that cash. And what if there's a big drawdown? Fair enough. But, the point is, like, you have different assets. And when you think about growing your purchasing power or keeping up with inflation and then some, it matters that you have monies invested and it's not just under the mattress. So don't be lazy. And when people tell you, oh, the dollar's lost it, yeah, of course it did. If you did nothing with it. All right. Speaking of, actually, it's bad transition. I was doing some data for, we're always doing sort of strategy creation, and I had some data on gold that I thought was interesting, and I figured I'd share it. Actually, before I forget, here, I'm going to go to the NYU Stern data, the real return. So the geometric average historical return since 1928, S&P 500 plus 6.7%. Again, I'm not saying you'd put all your cash in the market, but the real return after inflation. And then you look at the 3-month Treasury bill, 0.27%, the compounded annualized growth rate. Gold, by the way, plus 2.02% real return. But, it gave you a real return. Don't put your money under a mattress. All right, a little bit about gold and how I think it's more volatile than many people believe. So what I did was I was doing some analysis, and I had data going back to, let me see when I started this, July of 2007, which is about 18 years. Why 18 years? Doesn't matter. Some of the vehicles I was using were around a little bit before then or right then. So made sense to use it. And, part of, I'll give you a little insight when I'm doing strategy incubation or creation or research. A lot of times you sort of look at things over long periods. You try and view things in different environments where it fails, environments where it works. And you look at drawdowns, you look at volatility, you look at all these different things. And so I ran the drawdown. So the drawdown means, it doesn't mean from your initial investment. So let's say you started with $10,000 and it drew down to 5,000. But at some point it went up to 20,000 and then to 5,000. It's the drawdown from the high, the 20,000 to the 5,000. So the S&P 500, I'm using SPY total return, so including dividends, and the drawdown was minus 54.41%. That was, people forget that. 2008, it was minus 37, 38% for the year. But the drawdown was greater. The markets drew down back then, basically 55%. So I looked at gold over the same period, starting in, July of 2007, and using GLD, which is an ETF, and it's minus 46.74%. So the reason why I bring this up is, gold has definitely been on a run. It's had 2 very, very strong years. Does that mean it's going to go down? No, that's not what I'm saying at all. I'll let you know in 6 months when I know. I'll tell you what happened over the previous 6 months. But I think as you look at this, I think that might surprise you. Just for comparison, using another ETF, let me see which one I used here, SPTI, which is a 5, basically a target, 3 to 7 year duration. Their current duration, meaning their sensitivity to a change in interest rates, is just under 5. That had a drawdown of minus 18.73%. So the reason I sort of bring this up is with how gold is doing, and there's a thought that there's some people who believe, look, the dollar is getting weaker. Maybe gold is going to go on a multi-year generational run. And again, I don't know if that's going to happen or not. And I sort of remind people that gold goes through periods where it sort of does nothing. I just mentioned the real return after inflation is just a hair over 2% going back to 1928. And I know it's not really fair to go back to the 1928 period because it came off the gold standard. And so really you could look at other periods. In fact, Professor Aswath Damodaran does do that. And the real return from 1975 to 2024, 3.6% real return. 2015 through 2024, annualized real return, 5.62%. And of course, this year it's up quite a bit as well. So if we included this year, this data does not have that, that would improve upon that number. Actually, sorry, I gave you the average, the arithmetic average. So let me give you the right ones. 1928 to 2024, gold, real return plus 2.02%. 1975 to 2024, plus 1.68. 2015 through 2024, plus 4.9% real geometric return. And geometric average is basically what you would experience as an investor. It's, explain it quickly. Let's say you had a portfolio and it went up, went down 50% year one, it went up 50% year two. The arithmetic average would be 0%. But the geometric average, or the compounded annualized growth rate, I should say, is something like minus 25, minus 26%. So that's why I like to use the geometric or the compounded, the CAGR, the CAGR as we call it. But yeah, a lot more volatility than I think people realize. And although it has done better since 2015, certainly, even go back 1970s through 2024, you do have these periods. Look, I'm not saying it doesn't belong in a portfolio. We use it in something called decades that we run. We've got an allocation to it. It doesn't mean that you should. But my point is just understand what you're buying when you're buying an asset. And you might be surprised about volatility. You might be surprised about drawdowns. And I think gold is one of those that, people think that it's not that volatile, but historically it is. All right. Got to talk about the F1 movie. I am pounding the table, strong, aggressive buy. What was Goldman Sachs? Conviction list. I really like the movie. And look, I'm an F1 fan. There were some things that, wouldn't necessarily be possible. It sounds like Lewis Hamilton was advising them on the movie, but I thought the movie was great. It was entertaining. The music was good. And I like seeing in the movie theater. I thought it was a really good experience. And as I read into it more, it was the same people who did the Top Gun movie. So I think it was the producer and maybe the cinematographer. And I think you should go see it in the movies. I'm giving it a strong buy rating. F1, the movie. It's an Apple movie. It's an Apple Studios movie or an app. So I imagine at some point it's going to be on Apple TV, but I got to think you want to see it in the theater. It was a good experience. So other than that, we'll be back next week, have a guest on next week, and we're going to do a bunch of research for next week's episode. So I think you'll enjoy that. Hopefully everyone had a good weekend, July 4th. And if you are not in the US, hope you had a nice Friday. We like our international listeners. Send me emails, derek.moore@zegainvestments.com. That's derek.moore @Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. All right. See you, everyone.